Okay, so let's just take it a little bit further because we've kind of emphasized profit. So let's talk about practically. And so this is a lot of this stuff is for existing business, but there are some existing businesses online in the room. But for the rest of you, I want you to understand it so that you don't fall into the same trap that so many other people are. But truthfully, we can do this from day one. It's just that in a startup, we've got a slightly different kind of way that we look at it. So I'll try and sort of explain that. So we talk about saving the profit. Okay, so some of these techniques, even if you're not planning to make profit for the first year or so, they're very good habits to get into. The reason I talk about saving the profit is because I realized how good I was at spending. So I needed to kind of spend the profit. I used to say spending the profit, but some people got confused when I said that. So like the trick is, if money comes in and you want to keep some of it, we'll get it to disappear as quickly as you can. Now, you're doing that anyway, but you're giving it to other people, so it disappears forever. But you can get it to disappear into places where it's still actually yours, you just can't see it. So Anne will teach you that as well. I mean, if you just move that amount as well. John was, when I was having lunch with him the other day, was saying the same thing. It's like just when you start your savings plan or your investment plan, is like make sure there's a debit order taking the money out of your account long before you have to worry about anything else. And you don't even freaking know sometimes where it goes, as long as it goes somewhere, as long as you can see a balance. But you don't want to see it. So I'm like very much, if I can see money, I spend it. Most of you like that as well. So there's excess money lying around. It's not actually because you're going to spend it. You're going to find something else to buy, something else to another employee, some new equipment that you need. You'll find something. You'll find 10. Most of you already have 100 things in your head you'd spend the money on before you even have it. So, the conditioning is to spend it. So we turn around and say, well, look, we need a couple of things around money to actually protect ourselves. And so we talk about saving a profit. This is literally where we're taking money out and putting it into other places for different reasons, okay? And I'm going to teach you, like a lot of people that are not very profit-centric, you can do this anyway. It'll actually force you to become profit-centric. So the first thing we're going to look at is I'm going to go to the next page, is a VAT savings account. Now, obviously, if you're a startup, you don't have VAT, and I understand that. But there's a couple of problems with that. This is something that Robert should probably address more. Because you can voluntarily, like if you start up, the government's really saying, please don't register for VAT. The rule is when you make $1 million turnover in a financial year, you have to be registered for VAT. In fact, you have to register even when you know you're going to make $1 million turnover. So that if you even suspect that your business is going to make $1 million in the first year, then you go and register for VAT straight away. You're allowed to do it voluntarily because in some cases, because you can pay the VAT back, especially if you're starting off at a loss like a growing business, sometimes it's beneficial because all the expenses you pay that have VAT on them, you can actually claim back. And so then the government will even pay it back to you. So even if you're running at a loss, they might kick up a bit of a fuss, but they will pay you that money back to you because it's in the context of a system. So I'm not recommending that everyone starts a business by paying VAT from day one. But you've got to look at the pros and cons. So if you know that in the first year of your business, you're actually going to be spending more than you're earning, you've got an investment and you're going to be buying lots of equipment and things like this and blah, 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 you could actually get some of that back. Because if you weren't VAT registered, you can't claim it back. So please ask Robert or ask your accountant about that. But a lot of accountants say, no, because the rule is when you know you're going to make $1 million, you have to register for VAT, and that's all they say. But of course, it's called voluntary registration, which the government is more than happy for you to do whenever they want to. I mean, they're there to support you, supporting them. And I say that everyone has a negative thing about things like SARS. Like, they're not there to screw you. I mean, sometimes the individuals aren't that great. I mean, they're not always the best at customer service and stuff. But the rule throughout the world is your job is to pay as little tax as possible. The receiver's job is to make sure that you only pay as little tax as possible. That's the relationship. They're not screwing you. I mean, there's lots of countries that charge more taxes than we do in certain areas. Our government's pretty sensitive. We're trying to build an economy. If we screwed the consumer from a tax perspective, we'd destroy the economy, and then we'd have nothing to get revenue off. So, if all the departments, and our department, our receiver department is actually rated globally as one of the better receiver departments in the world. It's like with all the chaos of Zuma and everything else, we managed to keep our financial management department actually at a top international level. Occasionally we threw a person in there that maybe didn't have the best interest in mind, but the system was pretty well worked. So our receiver of revenue in South Africa is actually rated like in the top sort of 15 receivers in the world. That doesn't mean they're good at screwing you. That means they're just organized. Thank God, in all the chaos of our country, that we have some organization around money. It's like our banks are rated in the top sort of 10 security banks in the world. Like our banks are rated as some of the safest places to put money in the world. Like literally in the top 10 out of 170 countries in the world. They're very anal, but they won't lose your fucking money. That's the bottom line. So there's only been one bank who we had that, what was it, Suntum or something a number of years ago. And because of that, our registrar who manages that equation is even more strict because no one wants a bank to collapse. America in 2008, oh my God. Banks were falling down all over because America's got tons of little banks. And people, that's it. If your money's in a bank and the bank goes bankrupt, sorry for you. Who's going to give your money back? So South African banks, yes, they're anal. They're not very easy to get them to give you money to support you in business. They never really intended that. But they're some of the best in the world, so be grateful for that. And that's why they're so valuable as well. Pretty safe shares to put your money in is our 4 major banks. Because when you're anal with money like that, the more you respect and looked after money, you're probably going to be profitable every year, never going to actually lose money. So you can actually learn something from that. Banks, very simple. Learn how it works and play within the rules. Same with tax. All the negativity is just self-imposed because you created stress or you didn't manage things properly and now you're pissed off. People get pissed off. Pissed off. People owe you money. Like, I've never seen people, there's 2 things that make normal, supposedly normal, human beings who are not really that violent. In other words, they don't actually kill people. I'm assuming none of you actually, have on a regular basis killed people in your life. Might be 1 or 2 exceptions. There's 2 things that swing you dramatically in the weirdest way. The one is road rage. What? People want to kill people that they don't even know in a car. It's insane. Go on YouTube. You're like I don't recommend it because it's sad to look at. But there's literally thousands and thousands of videos of other people caught you get road rage, but a lot of you don't actually get out of the car, right? But the proportion, there's a proportion that do, but the level of road rage is unbelievable. Like you want to kill people. Like you swear, you don't even know the person who borrows soap. You don't know if they intentionally did. 99% of the time they didn't intentionally do something to you, but you want to. The next thing is in business in particular is people that owe you money. We're going to talk about that just now. And boy, I know this because you're talking to people and say, like, how do you feel about the fact that people owe you money? I want to kill them. Like somebody stood up in one of our seminars and said, I want to stab them. Like not just kill them. Stabbing is a more emotionally aggressive thing to do than poisoning them from a distance, right? And like there was a lady and she's like, I just want to freaking stab them, because we get so emotionally worked up. These systems I'm going to tell you about are what to prevent that, because that level of emotion is just completely destructive. Even if you don't do anything, it just completely eats away at you and creates huge amounts of stress. The car rage, go and work with Tony and then they'll show you how to deal with that. But when it comes to money, do these things. So if you don't have the VAT, that's okay, but if you do, put your VAT in. If you earn, so VAT is 15% now, so you build 10,000, so it's actually $11,500. As it comes into your bank, you take the $1,500, you put it into your VAT account. It's just a savings account that you attach to your account so you can see it. 15,000 goes in. So all the income, you're just taking the VAT off, putting in your savings account. Now, some of you aren't going to understand this because you haven't been in business, but there's a thing called VAT in and VAT out. So the accountant's going to look at everything that you spend as well, and they're going to record that. And when it comes time to pay VAT every 2 months, just to make it a little bit more complicated for you, the accountant's going to come along and say, right, we need to pay 67,000 Rand to the VAT man. And you're going to look in your VAT account, and you're going to notice there's 143,000 Rand in there. And you're going to go, really? We only have to pay them 63,000? And they're going to go, and you go, okay, it's there. Just take the 63,000 from the 143. And if you did this repetitively, I know it sounds like a little bit of it. You want to enforce positive experiences like this, because by doing this, it's literally always a positive experience. Don't think how much you're going to keep, because then it'll become a negative experience if it's not right. Just be surprised every time that there's money left over, but that's how the coin works. By forcing the money out, which is not yours technically, VAT belongs to the government. You're not collecting it for your service, you're collecting it on behalf of the government. So just taking it out all the time, and then letting that equation work itself out every 2 months, and actually realizing you only have to pay a portion out, you're going to realize there's money left over. You are going to manage your survival mode inside your operational account. You're not going to rely on that because you don't know what it is. You're just going to ignore it. But every 2 months, there's going to be a chunk of money left over. So what do you do with it? You put it into your cushion account. A cushion account is an account where you take the cost of your, by the way, personal and business, the cost of your life, or in this case, the cost of your business, and you save up enough money to cover, in business, we like to say 6 months. So if it costs you 100,000 Rand a month to operate your business, you want to save 600,000 Rand into a cushion account. Now be clever, put it into an investment account, attach them. It must be accessible, very important. You don't put it in a long-term investment because then you just put it into your personal wealth. Put in an accessible account, but the bank will give you accessible accounts that have higher interest yields and what have you, because when you've got lots of money lying around, it's really cool. There's a revenue stream you can have in your business called interest earned. It's a cool little revenue stream. It's not always massive, but I love the interest earned revenue stream because that's pretty much telling us we're making money. So that's when you've got positive money lying around and the bank is paying you a very small amount, but like we have, there's market linked accounts and what have you can put it in. As long as you can get it out straight away, that's very important, otherwise you'll stress. And you have 6 months. Now, what happens if somebody doesn't pay you? Do you get all upset? Well, you still get frustrated because, that's in balance, but you don't have to have a mini friggin' heart attack. Because you will, and this is the rule, you got money in your cushion account, so you got a 100,000 Rand client, they don't pay at the end of the month like they were supposed to, you go and you actually go to the accountant, like another thing, you say, listen, I'd like to borrow 100,000 Rand out of the cushion account. You almost, if you really want to be pedantic, actually create a little contract between your accountant and yourself, and they transfer the 100,000 Rand into your operationals account so that you don't have a problem because the client didn't pay the 100,000 Rand. The minute the client pays you the 100,000 Rand, it gets transferred back. So it's like borrowing it from the bank, but you don't have to pay penalties. You see, when you borrow it from the bank, you never give it back. Like overdrafts are the worst freaking thing in the world. So like, how's your business doing? Oh, it's like end of month, got a little bit of money. Oh, I need an overdraft, get 200,000 Rand overdraft. How's it doing? Minus 200, minus 200 every time. It's like in the wrong cycle with money, you create your own overdraft system. That's like the best thing you can do. And I've done all of this wrong for you guys like 20 times over. So please, I've done it for you. That's what my dad said about divorce. You're 5 kids, I got divorced 5 times, I've done it for all of you. Well, apparently it didn't work because I got divorced and so did my brother. We were just copying our parents like we do, So you put it in a cushion account, becomes the security, and it takes all the emotion away out of money, and that's why you should do it in personal life as well. But you leave it there, okay? So you don't take it into your profit because you can't get that out. You should never put your personal money back into your business. Initially, maybe as an investment, but I have a rule: never put your personal money back into the business. If it can't fend for itself, shut the friggin' thing down. If you have a cushion account, you'll never have to put your personal money back into the business. And if that cushion account depletes, which is 6 months of operation, and it's still going down, shut the damn business down. It's the easiest thing to do if you don't owe anyone money, which you won't because you had the cushion account, now it's depleted. But if you carry on, now you're going to start owing people money. Now you're going into overdraft. Now you have to borrow money. Now it's going negative. Now you've got creditors that you owe money. Now if you shut the business down, which you can do, because at any time you can choose to voluntarily liquidate or just close a business if you didn't owe anyone money. But of course there's a process. So if you owe people money, there's a process that's gone through to determine, It's not a very hard process. They're not going to come and screw you for it. The ones that will screw you, of course, is all the ones you signed personal surety on that you didn't kind of realize. So the banks will hardly ever give you anything without personal surety. So don't go and tell the bank you're not going to pay their $1 million back and I've liquidated the business. It doesn't matter because they actually have the right to come personally after you. SARS also, by governing law, has the right to come after you personally. If you mismanage money, you don't pay tax. But they won't, in most cases, if it's a nominal amount. And a nominal amount is like R1 million or something that's owing to them. I've liquidated a business with a SARS debt of R1 million. It was the first time and the only time I've liquidated a business, and it took me forever to understand. The truth is, I should have liquidated it when it had a SARS debt of 50,000 Rand. Because I effed around trying to fix the damn thing and was so emotionally attached, and I didn't want to give up because I'm going to fail, it's going to be a failure, and I'm going to be screwed and everything like this. I let that SARS debt become R1 million before I realized, shit, this business is really not working. Duh. SARS never even contacted me. Now, be careful, they can, so I don't want you to think this is an easy peasy. But I managed to liquidate that business without anyone knowing that I had liquidated a business. I paid off all this, I have this thing about other entrepreneurs, so we literally took over the debts of the other entrepreneurs and paid those off in the new business because we started something else. But we liquidated the debts where it wasn't going to hurt anyone by liquidating it. But, the business was frick. It was dead, and the longer I tried to fix it, the more I got into trouble. And it became an instant solution. Anyway, it's another whole story, but for people in existing businesses, flogging the dead horse is really not a very clever thing to do. And that's what I told you right at the beginning. Business is an entity. If it doesn't serve you, you shut it down. If you're clever, you'll shut it down before it gets into serious debt. If you weren't emotionally attached to it, and you had a 6-month cushion account, and the cushion account depleted over 6 months, or sometimes because you're not using all of it, but it depletes over 6 or 12 months, by then you should realize the business is in shit. Shut it down. There's actual laws as directors of businesses where you have to act in the best interest of the business, and some of us are really stupid. So there is actually recourse, even because you were stupid. But they will never pursue it because it's a challenging thing. But just understand it's there. You are responsible as a director of your business to do what's in the best interest of the business. You're responsible not to let that business get into so much trouble that you owe lots of people money. So make yourself responsible before you even get there. Cushion account, a 6-month cushion account will probably survive you 18 months in a negative business, even 2 years sometimes. For God's sakes, how long do you need to know before you realize the business is not going to work anymore? So, just deliberating on it slightly. But you won't have any of the emotion of putting your own money in and wondering how you're going to get it back. Because that cushion account's not even yours. You don't even consider it belongs to the business. And so it just gives you that period to realize you can actually move on or change or whatever or fix it. Capital savings account. So once you've got a cushion account, you could have another one. If you're an expansion type business, if your objective is to expand, to build more branches, to buy other people, buy other businesses out in your industry, whatever it is. If you know you want to expand and it's going to be a capital cost, that's what capital is. So you'll start after you've got your cushion account, creating a capital account. Again, that you'll put into even higher yielding investment accounts, because once it's come up and you want to buy a business or open a new branch, you actually have all the cash to do it, and kaboom. Now, please, you can borrow to buy infrastructure. There's nothing wrong. It's actually a good process, but you want to do it from a place of strength. So if you want to buy a business, it's sometimes nicer to buy it outright without borrowing, because then it's fixed by the time it starts. This is more complicated for existing businesses. You don't have to have a capital savings account. What you do have to have from day one is operational savings account. Anything that you have to spend later on that you earn now, you put away somewhere else. So, simple example, you buy Tony Robbins from us. So we get a commission on Tony Robbins, but we got to pay London because you bought it. So the minute you buy Tony Robbins from us, in the morning, Sally or the accountant will move that money across into, we actually have a Tony Robbins account, believe it or not. We have a number of speaker accounts, and the money will be moved across. We'll move often the whole amount, including our commission, and later on we'll take our commission out, which is revenue. You see, our earnings are only the commission, not what you paid us. So we have a number of different what we call speaker allocation accounts when we promote, that money as it comes in gets moved into. So for a couple of years when I started, I never did that. Yeah, well, whatever it is. Anything you have to pay. So if you're earning anything that you have to pay later on, you get it out of your operational account. That's the kind of rule. So, bottom line is, if you don't do that, the odds are you're going to not have the money. And you're going to suddenly, because the thing is, you see, because you're conditioned to spend, when you see the money, you spend the money. So, we can do, when we do our larger events, we might collect R1 million off something like Tony in one event, right? And that's a lot of money to have lying around. Now, we only entitled to, let's say, 30%, I think is a commission of Tony. So, we only entitled to 300,000, but there's R1 million there. If I leave that around and start messing around and paying things and blah, 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 and all of a sudden I have to find 700,000 rand to pay them. And the thing is that when it's there, you'll make that mistake, because you can't actually see it. You just see money. So, we got this bill, you pay that. We owed that person money, just pay that, everything. And then suddenly it's 3 months later and it's time to pay UK. And you're like, oh, shit. I don't have the money. So anything, that's contextual to our business, but anything that you earn in money for that you have to pay for later. So even in accounting, they have something called deferred income. So if you sell something like a service for somebody for 6 months, it's classified as deferred income. It's only income, so here's the rule in accounting, when you've delivered the service. Literally. That's how it's governed. So just because you've got money in your bank doesn't mean it's actually income. So, it's deferred income, and some accountants won't even tell you this, because a lot of businesses have this where they get money before they've delivered service. But, you should structure it. So operational accounts, for me, if I move the money out completely and don't see it, then I'm going to be a lot safer. But if I keep it in front of me, I'm going to mess up the equation somewhere in the process. So that's just, it's dependent on your business model, dependent on how your business operates accordingly. But you want to have something like that to move forward for as a whole.